What's up, friends? Welcome to the Lincoln Lawyer channel. It is a lovely Hurricane Saturday, August 1st. We are expecting a nice bucket of water to be dumped on us today, but I've been through a bunch of these, Cat 3, Cat 4, so in Texas, Florida, I'm not worried in the least. Just chilling here, decided to make this video for you today. It's going to be an interesting topic. We're going to talk about family limited partnerships, FLPs. Alright, so a lot of lawyers like to push these things because they are complicated, not well understood, and they're expensive to form and manage. So for obvious reasons, it is good business to push these things, but unfortunately most of the time you're getting had. So what is an FLP? A family limited partnership is just a limited partnership. That's all it is. Alright, very simple. A limited partnership, what is a limited partnership? So that's a limited partner and a general partner. You have two parties at least. Limited partner contributes capital and stays away from business management. He does not manage the business. He receives some of the profits and he has fully limited liability. Alright? A general partner manages the business, manages day-to-day activities, receives part of the profits, potentially management fee, and has full liability. That's what a limited partnership is. It is a statutory entity. So a limited partnership is filed with a state. All right. Now, some definitions of FLPs describe it as a family investment vehicle where family will invest with a general partner that's run by another family member, and it's just a family investment vehicle. Well, that's not really exactly what it is, okay? That's an incorrect definition. That's just a general investment vehicle. It doesn't have to be family. Like, why would you solicit only family when you can solicit other people? You can solicit anybody in a standard investment vehicle where you're investing in an asset, in a property, in a business, in any venture, whatever. It can act like a hedge fund. So that's not really an FLP. An FLP is generally used as an estate planning tool. Alright, so generally it's going to be used with the parents of minor children. They form an FLP, they are the general partners. So they manage the assets and they hold about 1 to 5% of the interest of the limited partnership. The children, minor children, are limited partners. They do not manage the assets, they have no control. And they hold about 95 to 99% of the interest in the FLP. Now, basically, it's almost malpractice. I would say it pretty much is malpractice to create an FLP and have the individual parents be the general partners, GPs, individually, as individual persons, in the individual capacity. So any lawyer worth his salt, any lawyer who knows anything about anything is going to have an LLC as a general partner, okay? So therefore, you need two companies, two entities. So you have the FLP, limited partnership, and you have the general partner, which is an LLC. So you have to form two companies to begin with, off the bat. And then the parents are going to be the members of the general partner, which manages the FLP. The way it works is basically they manage the FLP. You have to put assets into the limited partnership, like a business, a property, anything that generates revenues, and then the revenue is shared according to the interest owned with the children or the parents. The parents get a management fee, they can live off that, and the children, they may get an allowance, potentially immediate allowance in cash, or more common that the money they receive as distributions go into a separate account that they cannot touch, they cannot control, maybe a college fund, a retirement fund, whatever it may be. There's different options. And then upon the death of the general partners, the parents, then there's a number of options that can be used to either continue the management of the FLP, you replace the general partner with another general partner, you assign a different manager, you can put the FLP into a trust for a trustee to distribute or manage. There's a lot of different options. You can distribute the entire FLP to the children if they are of age. So that's pretty much how it works. So it just depends on what the family wants to do with the assets upon their death. The FLP interests are going to be personal property. So they are divisible in a will. They can go through probate, etc., or they can be put into a trust and managed or distributed according to the terms of the trust. All right, so as you can see, the FLP is rather complicated, and there's a lot of paperwork. There's at least 2 companies you got to form, and there's potentially trust documents. You got to put assets into the FLP to manage. So then there's partnership tax returns. You got a K1, 1065. It's not that easy. You need professional assistance. You need a professional CPA, and obviously you need a lawyer to form this stuff. So this is not something you want to do on your own. But is it advisable in the first place? Not really. So what kind of assets would generally go in an FLP? In there, you can put a personal residence in there where the parents reside. There's not much reason for that because, generally it's protected by homestead laws. Generally there's a mortgage on it, and if there isn't one, you can put a mortgage on it. You can get a HELOC. So you pretty much equity strip that asset to make it lawsuit proof, and it's generally not seizable anyway as a debt obligation. So just the personal residence, pretty much unnecessary, but it can be done. A residence can also be put into an LLC. So that's pretty much the most basic standard way to protect a personal residence of the parents, of the family. So there really is no need to create an FLP and give the children interest in it. If there's a family business, there's really no need to put it in an FLP. A business should be in its own multiple LLCs, generally speaking. There's multiple ways to do this kind of thing. It depends on the assets of the business, but there's going to be at least 1 to 2 LLCs, and you can make your children a member and a non-managing member, give them 99% of the interest in the LLC, and pretty much it serves the same purpose as a limited partnership. So you can do that. You can have managing members who are going to be the parents and non-managing members of a single LLC, so that's fine. And that would be pretty much the holding company of the business that holds the other assets of the business, but does not actually conduct the business activities. That would have to be another company. There's a lot of ways to hold personal property. Now a lot of them have survivorship clauses. Bank accounts, various brokerage accounts will have survivor clauses. Even real estate, there's new types of deeds that can pass ownership, can pass title on the death of the owner. Multiple states have these. These are relatively new. Insurance should not be held in an FLP for sure. That would probably go into a separate insurance LLC. So a payee on the policy, you can indicate an LLC that will get that insurance payout, and you have a member, much like a trustee, that will manage that LLC and distribute the assets to the ultimate beneficiary by whatever means necessary. There's multiple ways to do that also. So there's really no reason to do an FLP for personal assets either. So most states now have simplified probate. It's really not that expensive to get letters testamentary to change title to any property which you may need to change title to, like a car, for example. Anything that's registered with the state, it's really not that expensive to open an estate, get letters, change title, and close the estate. I mean, if that's pretty standard. Most states have that. So there's really no need for FLPs for that purpose either. So one advantage of FLPs that's touted is discounting. All right, so discounting is going to be a tax benefit for the holders of majority interest, like the children that hold it, because they have a lack of control and there's no marketability of those interests that they hold. Then the value of those interests are going to be marked down annually, generally speaking. So you don't show a capital gain every year. So it's marked down substantially. Could be from 10 to 30, 40, 50%. You can do that. Generally it's okay, but it will attract additional scrutiny from the IRS, and it does raise chance of audit if they disagree with the discount. So there's a big possibility of an audit right there if you take too much off the interest, and potentially the cost of the audit would negate any tax benefits that you may receive from negating that interest. So you got to be very careful with doing that, and make sure that your CPA knows what you're doing. And again, you got costs, administrative costs of the CPA, and potentially cost of the audit. But discounting is also available to LLCs, so it's not something exclusive to FLPs. So you can definitely take advantage of a discount on the interest value in an LLC membership. So generally, the children in an FLP who own most of the interest are going to be in a low tax bracket anyway. So even if you show a capital gain on the interests annually, then the taxes would be utterly minimal. So it's not really a huge threat. And additionally, any gift tax exemptions that you may benefit from transferring assets to the children annually, as far as, you know, gift tax exemption, it's 13, 15K, whatever it may be, 30K for a couple, changes annually, so whatever it may be. So that's available to anybody. That's available without an FLP, without an LLC. That's, you know, you don't need to go through the trouble of creating an FLP or a trust or an LLC, etc., moving assets in there. You can take advantage of gift tax exclusion no matter what, period. There's some liability issues with FLPs, all right, because you're members of the same entity with your children. In case children, you know, are held liable for an act, let's say car accident, let's say they have a car, 16, 17-year-old, they get into a car accident, it's their fault, well, the parents are liable. So it's basically all minor children will have their parents that are actually liable for their acts if they hurt somebody, whatever. So their interests are seizable, and then the parents' interests are also, you're subject to charging order. So the children's interests are subject to charging order, and the parents' interests are subject to charging order. So you don't really get that much protection by mixing the family, the children, with the parents in the same entity. There's really no point to that. So that's something to think about. Basically, you know, the children can be sued, the parents can be sued, and FLP interests are personal property, and so therefore they're subject to a charging order. So if there's any distributions to the children, then they can be subject to that charging order, and the parents would have to distribute it to the creditor. And of course, if the parents are subject to a charging order, then if they make any distributions to themselves, then they're also subject to the charging order. So both parties can simultaneously be subject to a charging order for the same act of the children. All right, negligence, gross negligence, criminal activity, whatever. So there is potential for that, okay? So you need to understand that. There's definite risk in that. And furthermore, you really don't want to lump a whole bunch of assets in one FLP. There's no point to do that. So you're still going to need to segregate your assets. You're still going to need to segregate property, segregate business, you know, valuable personal property, any income producing property. You can't put all that stuff together in a single FLP. That's crazy. So you still need to segregate all that. So you may need to create multiple FLPs. I mean, that may end up being the solution. So that's a real big major pain in the ass. It's very expensive to do that. So there's simpler solutions. So to finalize, basically a single LLC can act the same way as an FLP. There's really no need to create an entire FLP and move limited interests, limited partnership interests to your children, and have a separate manager created an LLC. So there's no point to do that. You can do all that with a single LLC, with a single asset, you know, income producing asset. You can put that in an LLC, make the parents the managing members, make the children non-managing members, and get the same result. There's really no need for statutory partnership filings these days, because the LLC really is much more versatile. So, and then it has the election of the tax filings. You can file as a corporation, file as a partnership, file whatever, you know, file as a C Corp, S Corp, it doesn't matter. So there's a lot of variability there. All right, so I'm gonna wrap it up here. And hopefully you found this entertaining, educational. Remember, this is the series on legal bullshit. As I said, land trusts are bullshit. FLPs are mostly bullshit with some benefits. So thanks for watching, and be cool, stay safe, stay dry.